Brad Williams, Frugal Finance. After this session, I suspect I'm going to lose a lot of you. Why? Well, because this is where it gets a little hairy. And as we progress deeper into this, it's just going to get this. It's just finance. Okay. This is basic finance stuff. And if it's new to you, again, you're going to go, I'm going to focus on some other stuff. Don't. Okay. There's a reason why there's a huge demand for finance experts. And I'm talking people that are doing quants and derivatives and what have you. Why? Because it takes a little bit of work. Now, you day traders that got lucky, or some of you that have been lucky in the short term, it's not a long-term game, and you'll open up something like this and just going, that's all bullshit. I'm not gonna, focus on that. I'm just gonna buy my options. You don't have a darn clue of what the functionality of options are, but you've been lucky so far. Okay, you go to a casino, perhaps you're gonna get lucky for a while. Well, you day traders buying those meme stocks, it's stupid, all right? It's short term. And like I said, some of you are gonna get lucky and some of you are gonna just lose your ass. And why? Because I've been there. I've done that way before meme stocks, okay? And you just don't have a big enough bankroll in order to do it long term. You have a big bankroll and you are extremely disciplined. There's a lot of rules in order to successfully day trade. If you veer off that path, well, you're done. Now, some of you are smart enough to understand the complexity of day trading, and it's very few. This stuff would be simple for you. But the majority of you that are just piling in when you're probably a college student, it's summertime, you're bored, so then you go to Reddit and you read all that garbage about some cat and meow and dogs and that stupid crap. Well, that's exactly what it is. And again, you're going to get lucky, you're going to make some money, but in the long run, no. So that's why I said, if you're interested in finance, then learn finance. Don't just be one of the herd people. You get this flock of people all following this trend. And look, that's fine. If that's your thing, you make money, I say thumbs up. There's the majority of you that are going to go, oh, I just lost $1,000. You're going to shrug it off. You lost $1,000. But 100,000 people losing $1,000 is a lot of money. And that's collectively how Wall Street works. It's a sucker's game. And when you're betting against a BlackRock or a Goldman Sachs or a Bank of America and Citi who have hundreds of billions available, and they can simply short your long positions, and you're going to be sitting there going, the house's pocket is much bigger than yours. So with that being said, computing discounted spot rates, term structure, and future value using discounted spot rates. I know you're just going, I don't understand that. Well, let me try to explain to you what this is all about. Let's say you have a bond that will yield a $100 return in 2 years, plus interest at the rate of 6% per annum until then. Nothing new. We've done this a zillion times. For a total of 2 years, in the 100 at the end, that translates to $3.40 every 6 months. Basic stuff, okay? Now let's discuss discounted spot rates. These rates can be thought of as future money discounts. Your future money's value would have to be discounted by 6.8% interest if you can receive it every 6 months in order to determine its current value. You can calculate the current value by discounting all the future payments at the specified rates. For instance, the first $3.40 payment is worth $3.30, $3.04 to you today if you discount it at a rate of 5.8%. Once you do this for each payment and total them, you will know the bond's current price. Let's now discuss future value. That's the future value of all these payments. You can obtain the future value if you do not discount them and instead continue to add up their current values. It is $113.60 in this instance. Finally, there is continuous compounding, which is essentially extremely quick compounding. It is a method for figuring out how much money is worth when it is growing constantly, such as every 1/100th of a second. To calculate how much your money will be worth with continuous growth, you use a formula. To put it briefly, discounted spot rates provide us with the bond's current price. Future values inform us of the total future values of all payments. And continuous compounding allows us to compute growth extremely rapidly. We have a face value of $100. We have a coupon of 6%. We have a future value $3.40. That's the interest. Semi-annual, $340, semi-annual with semi-annual payments. We're just going to go $340, $103, and then there's our value. Why $103.40? Well, it's 3 years. So what's going to happen? Is this 4 years or 3 years? Oh, it's semi-annual. Okay. So it's 2-year deal. We're going to receive $340 every 6 months, and then we're going to get our $100 back. So you just add that up, and it comes out to $114, maybe some change. Let's see. Yeah, there's some change there. Now, time. We have half a year, 1 year, 1.5 years, 2 years. Our time, spot rate, 5.8%, 6%, 6.4%, 6.8%. Semi-annual discounted. So we're going to take 5.8%, 1 divided by 1 plus C33. Here's C33. Divide this by 2. And we've done this before. I showed you in the continuous compounding, session 1, what this is all about. So we discounted this semi-annually. The price, C30, right here, C30, 340. 1 divided by 1 plus C33, 5.8. Divide this by 2. Take it to the term, C32, which is half a year. Big difference before. And then we're going to take semi-annual. We're going to multiply that times 2. Gives us a semi-annual rate discounted at 3.304. That is the discount. Then we look at 3.40. That will be the future value. And that's this 3.40. So now we look at 1 year, 6%, 340. Okay, so you have 340, 340, 340, and 103.40. And you add those up, what do you get? All right. Then if you go back to the discounted part, it comes out to $100, as it should. Now, if we have continuous compounding, we're not going to have to do anything magical here other than follow the formula. Because we're using the EXP, we're going to look at C33. This is that 5.8 rate. All right, just go with me. We'll get to how to compute this 580 to 6 and what have you soon. Just go along here. So all we're doing is using EXP, but we're using this spot rate. And we'll figure out how to compute spot rates soon. We're doing the exact same thing, but notice the difference here. It's minimal. Look at semi-annual compounding. Look at this rate, 971817. Here it is with continuous, 97142. And we're going to come up with 330. 330. Okay. So in other words, well, maybe, let's see. So we're going to come up, and now we're working with some tiny numbers. Continuous compounding. You can see it's discounted 330.28 as opposed to semi 330.042. And then 340. This should, with continuous compounding, we're using C33 again, and C38, it should equal 340. So what we're doing is we're taking the discount rate, we're taking the spot rate. All we're doing is discounting, just discounting it based on the term. The term is half a year, and what it does, it's going to come up with the equivalent. This is the equivalent of what we did earlier. Now, you can verify this. All we did was discount this. If you take this 9985 and with continuous compounding over 2 years at 10%, whatever that rate was, it's going to equal 11360. We already know that. That's with continuous compounding. If you take 11360 and discount it back semi-annually, it's going to end up $100. Here it's 9985. This is a rounding issue. Don't be overly concerned there. Now, equivalent annual rates. Now you're saying, what are zeros? So now we have annual for daily, continuous, semi. And what are zero rates? Formula here. What are we trying to do? So we have 1 divided by F34. So we're going back up here, F34. Find F34. Here is this semi-annual discounted, F34. And we have 1 divided by F34. We're using this formula, 1 divided by C42. So that's 1 year, C42. We're going to multiply that C42. So now we have a zero rate of 6.9156. 61956. And then we discount this 6916 to 0.87. So we go 1 plus D42, this number. What is the discount rate? 8748182. Why? Because we're going to use this discount factor here for the 2 years. And then here we're going to go F34 again, F34, and all we're using, we're going to change the ones to fours, and we're going to get 67. That's the zero rate using quarterly. Daily, as opposed to annual, 668, 6878. You can see how close the numbers are. And then semi-annual is 6.8. And this discount factor should be the same. Why? Because we're all within the same timeline. It's still within the 1 year period. So we want 1 plus D42, which is this D42 and D46. Divide this by D46. So the discount factor should be the same. Now, normal compounding, here are just some formulas. I've gone over these repeatedly, so I will go over them again. We have normal compounding. We've used this again and again and again. You can go up and you can use this formula and convert these over. We have normal compounding with compounding. So here we have frequency, daily, monthly, or semi. We have continuous compounding equates to daily compounding. Use this formula. Discounting, continuous compounding to daily compounding. That's discounting. Remember, we have continuous compounding. We want to discount it. We're going to put a negative sign there. Continuous compounding, normal compounding equivalent. Key to remember these four. Why? Because we're going to use them constantly. Don't overthink this. Use the tools. So if we go up here, we're going to find these formulas up in here. We have this 1 divided by 1 plus D43 to the fourth. So that one is going to be, well, we've got to find a discounting. So 4, because we're looking at zero rates. And then we just have this basic discount factor. So there's no price there. Now, in terms of continuous compounding, normal compound equivalent, you're going to use this. That's for normal compounding rate, continuous compounding rate. Compound frequencies per year. So continuous rate, equivalent normal compounding with frequency. And then normal compounding equivalent continuous compounding. All right. Then we have this $1 discounted continuous, 10%. So we have 9084, 1EXP, 1. Nothing new there. And then all we did was semi-annual and then for quarterly. Okay, right here, annual, semi-annual. We've done this time and time again. All right, there's no magic there. Is there any particular formula to use? I think we're using this right here. A, blah, 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 EX, RM, RSC, minus 1. So yeah, we're using this one right here. And then For future value, what we did was we used this log normal. So what we did is we took this D64, and we just converted it back over. I just put these numbers in here. This is just what we're working with. Here's the discount factor. We're going to use this formula. We went future value. We've done this time and time again. This is just practice. And then this EXP, we're going to use. You can also use this, all right? What are we looking at? This is what we worked with earlier. This is just a reference. So we have a compound frequency 1, 2, 4, 12, 360, and continuous. We have this, and again, this is the same thing as up here of the continuous compounding earlier. So there's no news here. Look at the formula above, and you can see what we're doing. And then all we did was we discount this back. And what do we use? It looks like we're using this formula here. Looks like we're using this formula here. And we're going to discount. So we're going to use this log normal here. Then how do I reverse this for future value discrete using continuous compounding? You can start manipulating the algebra and just to see what it is. And this probably makes no sense to you, but it did to me when I did this. Here again, all we're doing is using the formulas to convert back to our original rate. So what I did here is I went EXP E73. This is probably not worth even recognizing, but it was a question I asked, and I'm probably still looking for an answer. Again, you're looking at this 959, this continuous discount from discrete. We're getting 953. Why is it always the same? Again, I pose that question to you, provide an answer. And then all we're doing is using EXP to convert it over. We have traditional future value. It should be the same over here as this. Then traditional future value. Again, no magic there. Here are the formulas. What am I doing? I'm just taking C65 up here and 1 plus C64. Then I'll probably use something over here. C65, C64. This is just some traditional stuff. It's notation. It's the same as this right here. When I do this, I like to practice, and this is what I do. I get into these silos, my thinking. I get into the zone, and then I just repeat it over and over and over. So I can see the pattern. Traditional future value, traditional discount value, traditional discount, traditional future discount. You can see there's different ways to do it. Then there's an equivalent, then there's a future value. And I'm just showing you different ways to calculate this. You can see now we're using EXP. So it looks like I'm doing some forward pricing here, or I'm thinking about forward pricing. And then I'm discounting it back at some rates. There's nothing wrong with doodling. This could be considered doodling. Why? Because you may find that you're working through this stuff and you go, interesting. And then you look at these formulas and you go, well, what if I do this? What if I do this? What if I do this? And then you just start plugging and chugging. And this could be plug or chug. Or you can just delete it all and do your own doodling. Here's my tip. You're going to find yourself maybe early in the morning. Okay. For me, I get up at 4 in the morning and I spend a couple hours just without any distractions. I just get into a zone. And sometimes it takes 3 to 4 days to get into the zone. Once I'm in the zone, I like to stay in the zone, and I'll stay in the zone for probably 3 or 4 days, and then I'm so friggin' tired, I'm done. This is probably when I was in the zone, and I just start doing stuff like this. I don't expect you guys to rehash this stuff, but you may find yourself getting into a zone. And when you do, just go for it. Just go for it, because if you're a writer, sometimes you get in the zone and you just start writing. And it's just brilliance, or it's pure garbage. That's fine. That's what this is all about. You experiment. You start working through this is just simple algebra. Just break down the algebra, see what works, see what doesn't work. And here's the great thing about this. You can always save, and if you don't like it, you just go Control D. Now, the great thing here, you can always hit Control Z to bring it back. And then you hit save and you go, interesting stuff, not for me, or yeah, it's really interesting stuff, and you move on. Yep, we're stepping into the weeds. So hold on, be patient, and I'll try to explain this the best I can. This section right here is confusing, all right? And I'm going to try to explain it as we work through this, because we're working towards spot rates and forward rates. In order to compute all that stuff, we have to use some crazy discount factors. All I'm asking is that you just be a little patient, and I'll explain all this the best I can as we work forward. Brad Williams, Frugal Finance. Hang in there. You're doing great.